real euphoria in Elkville. In a week in which gold and silver remained dead in the water, the stock market perversely fattened on its own pessimism. Following the report that a new record had been reached in short selling, that's the sale of borrowed shares by bears who think they'll buy them back cheaper later on, the market cheered up and had its best day in more than a month. Frank Cappiello, a much better holiday week, but on unconvincingly low volume. Does that bother you at all?
Well, it bothers me a little bit, but typically this is the day after Thanksgiving, you'd have that low volume. We could have been lower in terms of an uptick day, but looking at what happened today, there are a lot of ups. 8 times as many stocks moving up than down, very plus. So I would look for the volume to pick up next week.
What do you make of a market that's down 31 points one week, up 32 points the next week?
Ambivalent?
No essential change in the news?
Ambivalent, is that the right word? I think, you know, the pluses out there are pretty obvious, Lou. Falling interest rates, an economy that's slowing but will not dip over to recession. And another plus...
Is that guaranteed now?
Well,
because there's some controversy there.
Yeah. But I think another plus that's been overlooked is the coming détente with the Soviet Union. You know, we mentioned this earlier, I think, in the fall, that there was a possibility that the Soviet Union with the Gromyko visit would begin to make overtures, and that's in the mill. And I think that's very positive for the stock market.
Why is that?
Well, because this will allow Reagan to do something that he hasn't been able to do, and that is to cut the defense budget, or at least top it out, slow it down. And that would remove another negative out there.
Bob Stovall, do you agree that it's peacemongers on Wall Street?
Only partially. I'm pretty pleased that the market was up the Thanksgiving week. There's an old saw on Wall Street, Lou, that the bears may have Thanksgiving, but the bulls have Christmas. That's another way of saying that seasonally we're frequently weak in late November. Now, we had this strength partially because the Federal Reserve Board took the lead and cut the discount rate, even though the other money rates didn't really say it was indicated. So the Fed is telling us that I think it's moving toward even lower interest rates.
Now, the opposite view, as you know, is that this is panic by the Fed because it sees us plunging into recession and that corporate profits are going to be down, and how can the stock market be up if corporate profits are down? How do you respond to that?
I wouldn't get panicked at all. How can you predict a recession unless you reach past logic to some sort of guruism? Because you've got a built-in 7% increase in military spending next year that was already placed in the order books 2 years ago. You've got consumers with their saving rate up and optimism fairly high, cash flow is up, and I just can't see a recession developing.
Bob Nurock, as the keeper of the elves, maybe you can tell me why 2 weeks ago the elves moved to a neutral position. The market then went down 31 points and they grew more bearish. Now, what's going on over there?
The elves, the indicators are as volatile as the market. I think the key, though, is to look beneath the surface. And the interesting thing is now, although there seems to be a lot of bullish sentiment around, I really detect a tremendous amount of underlying skepticism and concern that this may be the last rally phase. And because of that, I'm really bullish, and I think we're going to make a huge move here and go farther than anyone expects and be much stronger, and I'd be an aggressive buyer right now.
Well, that's certainly forthright. What are some of the signs you see of disbelief?
Well, the news reaction, the news background this week has helped to foster a tremendous amount of uncertainty. Some of the things that I've read that were written at the end of last week and even the early part of this week seem to indicate that everybody was sort of expecting some sort of rally, but I get the feeling it's a rally to get them off the hook because there's an inability to believe that the market could continue upwards from here and really make a decent move without falling back rather sharply.
Since you're being so bold, tell us how far, how soon?
Well, I think we're going into new high ground before year end. I think there'll be a mini pullback of some sort early next year, and I think we'll be in record highs in the very early part of 1985.
Oh, you old gloom and doomer, you. All righty, maybe he's right. This is the point in the program when we usually pause for a round of viewer questions. Tonight, though, we have 1 or 2 extra questions we thought you'd want to have asked of our special guest. But next week, we'll be back to what passes for normal around here. So keep your questions about life, money, and love coming to us at Wall Street Week, Owings Mills, Maryland, 21117. That's Wall Street Week, Owings Mills, Maryland, 21117. Now, before we meet tonight's special guest, let's cast our minds back to his last appearance on Wall Street Week, on March 6, 1981. 2 months earlier, Joseph Granville had become an instant celebrity when he was widely credited with single-handedly driving the market down by 24 points with a dramatic sell signal. 3 days, as it happens, after he had exhorted his followers to keep on buying. talk show hosts who didn't know a Dow from a cow fawned on him as he let the world know how astoundingly easy it was for him to catch every important up and down in Wall Street. And when I queried him more skeptically about it here, Joe Granville explained without reservation that he had only one job to do.
Well, Lou, our job is to put you in at the bottom and take you out at the top.
And one judge,
One judge, Louis, and it's called the market.
and one theory.
I have one theory, Louis. Again, is to put you into the bottom and take you out at the top.
Randy was feeling pretty confident about it.
Well, I'm simply saying that I have not made a major mistake in the market for almost 7 years. And the mistake I made was a horrendous mistake. And what it was I was mixing fundamentals with tactical. Now we have purified that. We don't look at anything outside the market. The market is its own total authority.
And on that, alas, he proved all too accurate. For the following year, while Joe Granville remained the biggest bear this side of Yellowstone, the stock market he thought he knew so well confounded him by launching its strongest advance in 40 years. What has he learned, and what does he think now? For the answers, let's go over now and meet tonight's special guest, Joseph Granville. Joe, welcome back.
Louis.
Nice to see you again.
Great.
Please. I liked Joe Granville before he pronounced himself infallible. Indeed, this is his third appearance as my guest on Wall Street Week, and I like him now. Not only is he among the most colorful personalities in a too often drab profession, but his highly professional early work in technical analysis has influenced many of his colleagues. Indeed, when he was last here, as we've just seen, the author of the Granville Market Letter indicated that his big mistake of the 70s, he missed the big move then too, though in the opposite direction, had come because he was not sticking to his technical indicators. Joe, what went wrong this time?
Well, we have a 9-year cycle here, Louis, and even I wasn't aware of this until my biographer uncovered this amazing fact. In fact, my biography will be out in the bookstores in January, and everyone can read it, but...
It's written by Boswell?
Well, something like that. It's by William Hoffer. As a matter of fact, he has an article in Barron's this week, and I wasn't even aware of that until I saw it. But he found out that Joe Granville has this tendency to fall flat on his face every 9 years. So when I did that in the summer of 1982 and realized I was totally out of gear, of course, the lesson which I hope people learned a few months after that, as well as the lesson I learned, is that you better follow me for the next 8 years, because my next major mistake will probably be made in 1991.
This is the Granville way.
The Granville way.
Okay, Joe, let's face it, the market hasn't gone the way you said it would. You predicted the Dow would crash to near 550 in 1982, actually moved to an all-time record 1,070. Then you said it would drop to 450 last year. Instead, it rose above 1287. I love your letter. Last month, your headlines on successive issues, I wrote them down, were fasten your seatbelts, sitting on the fault line, and into the chasm. But last time I looked, the Dow was still above 1220. Isn't it maybe time to change this same old broken record?
Well, I'll tell you why we're not going to change it, Louis. Very important reason, too. In history, we had a small band of people in the 1920s, including such people as the financial editor of the New York Times. His name was Alexander Noyes. We had the very famous editor of the Wall Street Journal, William Peter Hamilton. And then, of course, we had the nefarious Roger Babson and so forth. And just before the crash, we had Joseph Kennedy, and we had Bernard Baruch. So a small band of people who saw major trouble coming. They were too soon. As a matter of fact, Hamilton's warnings started in the Journal as early as 1926. Babson made his first very important crash prediction in 1926, all dead wrong. But as they got closer to that fateful year of 1929, these signs not only did not go away, but they got worse. And then, of course, it happened. Now, nobody knows the day nor the hour. Certainly I don't. But I do know that it is very, very late. Right now, I've been doing research for the last year and a half on a growing number of what I call 1929 parallels. Most of the time when you mention that year, people's eyebrows go up and say, oh, that's never going to happen again. As a matter of fact, a front page story in the Wall Street Journal on October 12th this year, just last month, was that all our top economists and Nobel laureates and so forth see no depression coming.
Let me stop you right there. You're the same Joe Granville who told us in 1982 that you didn't want to mix in fundamental analysis with technical analysis. You're the guy who said, what does the economy have to do with the stock market? Nothing. What do interest rates have to do with the stock market? Nothing. Now, when you've been wrong about the market for 2 years, suddenly you're back to fundamental analysis.
Louis, we would be frightfully dull if we weren't subject to change and flexibility.
But isn't this the same mistake you told us last time you were going to avoid?
Only to a degree. It would be a mistake if I divorced myself from technical analysis, which we would never do. The technical precedes the fundamental, and when the market told us in the spring of 1983 to tell everyone to get out, as I told Ted Koppel at that time on ABC Nightline, flee for your life. Now, of course, they did not believe me. I didn't expect them to believe me after making that horrendous 1982 error, but everyone makes mistakes, of course, in this business. Everyone in this room and everyone else, okay, over a period of time. If you have to make a mistake, and we all do, always miss a bottom, but don't ever miss a top. You see, when you miss a bottom, in the main, since so few people ever go short on a stock, all you're costing people are lost profits. You're not cutting into their capital. But if you miss a top, then you cut into people's capital. Now, yes, Joe Granville missed the bottom in 82, but I contend in answer to that, Wall Street missed the top in 83. And
Well,
there are
Joe,
millions of people listening to us tonight who are locked in with horrendous losses since the spring of 83.
Joe, you're absolutely right that everybody in this room is human. Everybody in this room makes mistakes. According to the November issue of the Hulbert Financial Digest, which rates all the newsletters, your aggressive traders portfolio is up this year by 5.5%. That's roughly the rate on passbook savings. It was down, according to Hulbert, by 25% last year, 30% in 82, and even in 81, when you were getting all that publicity, down by 3.3%. Now, could it be that you're just being too darn stubborn this time and not responding to the market that's going another way from what you're saying?
Louis, not necessarily. That is the past, granted. And naturally, we have sharpened up our performance since 83. As you will see, in terms of timing, we're number one in Hulbert. I have developed a device called my accumulation distribution short-term trading barometer, which we shortened. We call the ATIS trading barometer, which has given us virtually every bottom and top this year. And where do we stand right now? I would not be surprised. I made the case about 3 weeks ago in the letter that we could easily come back up above 1250 in the Dow again. It would not change the major picture. This is not an investment market. We are addressing ourselves primarily to short-term traders because, as we know from the record this year, anybody who went into T-bills this year outperformed the S&P.
How high would the market have to go this time before you would say, I was wrong?
Well, to take a ballpark figure, and of course this is always pure guesswork when we make these projections because all projections are subject to change. We're not going to put ourselves in a position where we're so inflexible that we're going to break like a stick as we did in the summer of 1982. I would simply say that it would not change my scenario if we went back above 1250. We have laid down parameters since the August 10th reading, which I felt was a very important top in the Dow in this bear market rally. And even at this point, we have not fractured any of the major parameters. As a matter of fact, when Bob Nurock's buy signal last May, and I believe we were at 1186 in the Dow at that time, the advanced decline line, or market breadth, has never come up above the May level.
I don't think you answered my question. What reading on the Dow would you say I was wrong?
I would not expect that we're going to better 1300. But I would also cover that and say if we go above 1300, I'm pretty sure that my barometer will have me on the buy side at that time. Right now, we are not on a buy signal, and yet we do expect that there's going to be a little fireworks on the upside over the next few days going into early December. This does not change the big picture one iota any more than that little brief flurry did last December prior to the January slide.
And how low next year?
I would not expect that we would go as low as Donald Hoppy saw in a recent Barron's article. I think he said 485 by 1987. However...
Forget Barron's. They're the ones who printed your bad predictions in the past. Tell us what you think.
That's correct. All right, let's put it this way. I, more than anyone else, would be the least surprised if we came down into the 600-700s in 1985.
Let's turn to some guys who would be surprised. The panel starting with Frank Cappiello.
Thank you. Joe, you've been bearish, and you keep on saying that the market is your indicator, has the message. What is it about the market, if you could give it to us in a sentence or two, in terms of a technical indicator or a fundamental indicator? What one or two things really bother you about this market that's made you so bearish?
Let's keep it very simple, Frank. And in terms of my 1929 parallels, the advanced decline line topped out in December 1928, 9 months before the Dow high. We've done virtually the same thing in this market. The advanced decline line, as you know, topped out in June 1983. You add 9 months from there. It's usually 6 to 9 month lead time. That bothers me. Number two, the high-low indicator. We've come nowhere near the maximum number of new highs that we had in 1983. Plus what we would call the pockets of depression among stock groups. Certainly technology, certainly steel, coppers and so forth. Some drug stocks and a number of other stocks which are actually mini 1929s. I mean, you talk about stocks like Apple Computer. I don't remember Wall Street getting you out at 63. The stock's down in the low 20s now. Merrill Lynch is a beautiful example, the equivalent of 112, split 2 for 1 at 56. The stock's half that right now. Heck, these were equivalent to the percentage declines you had in the crash of 1929. The Wall Street Journal ran a list of key stocks in November 29 at the bottom of that first crash leg, and it averaged somewhere between 45 and 55%. And you know there are dozens of stocks that have done a lot worse than that.
Joe, if I could, I'm not going to bother you with selective total recall accusations, or what I point out to you that in 1929 we had 40% of Americans on the farm versus 3% now. We had no middle class then of any size. Now we have a huge one. Consumer credit wasn't a factor. We didn't have transfer payments. But those are all fundamentals. When you and I worked together some 25 years ago, you were great on technical indicators. Give us your 3 technical indicators that the average viewer should watch for to look for a change in market direction.
All right, as I told Frank, the advanced decline line, the high-low indicator, and I would say as a third one, you must carefully watch what we call the harmony of groups and other markets. Most people watch the Dow. It's the most over-publicized indicator. And certainly we have the most horrendous action in the American Stock Exchange. As a matter of fact, as I sit right here, in the last few days, the American Stock Exchange advanced decline line has been making new bear market lows. If you looked at that advanced decline line, you wouldn't even have known that we had a 153-point rally this past summer, which, of course, as you know, I called.
Joe.
And it's a very interesting story on why I